U.S. natural gas futures has fallen again during the early hours here on Tuesday, marking a fourth consecutive session of losses, pressured by forecasts for warmer weather nationwide and lower demand projections in the coming weeks. This market is dropping into fresh new low territory this morning because weekend updates to the short-term temperature views failed to offer a significant change within the short-term forecasts. Meteorologists predict warmer than average temperatures across the nation through January 20th, with heating degree days expected to decline from 369 last week to 367 today, remaining way below the 30-year normal level of 458. HDDs are a metric for gauging energy demand for heating buildings. As a result, the market has now slipped below the $3.50 level and is beginning to eye the $3.20 area as a potential downside target. That's relatively low for this time of year, which is prompting some traders to view current prices as an opportunity, either for a technical bounce or on the back of a favorable weather shift toward colder temperatures. A colder turn would naturally revive demand expectations. That said, actual natural gas burn has yet to accelerate the way many had anticipated, suggesting demand is still lagging expectations despite the seasonal backdrop. Analysts project average U.S. natural gas demand, including exports, to edge higher from 133 billion cubic feet per day this week to 134 next week. Notably, the current week's estimate was revised lower from Friday's outlook, while next week's projection was nudged modestly higher. Average natural gas production across the lower 48 rose to 109.2 billion cubic feet per day in January, remaining just below December's record monthly high of 109.9 billion cubic feet per day. At the same time, average feed gas flows to the 8 major U.S. LNG export terminals have increased to 18.8 billion cubic feet per day so far this month, surpassing December's previous record of 18.4 billion cubic feet per day. Meanwhile, J.P. Morgan analysts reiterated that their constructive outlook for 2026 remains intact, driven primarily by continued growth in LNG feed gas demand. That said, they cautioned that this bullish thesis is positioned in the later stages of their call, with potential supply-demand headwinds beginning to emerge in 2027. Natural gas remains under clear downside pressure after breaking and holding below the $3.50 level, confirming a bearish short-term structure. Momentum indicators continue to point lower, with rallies being sold rather than extended, keeping price action heavy. On the downside, the $3.20 zone is the next key technical target. This area represents both a psychological level and a potential short-term demand zone. Meanwhile, many traders are betting that the current warm pattern is nearing its end and are viewing today's depressed prices as a buying opportunity. As a result, a rebound is possible this week if weather forecasts begin to signal a shift toward colder conditions. On the upside, any bounce is likely to face initial resistance near $3.50, followed by stronger resistance in the $3.70 zone. A move back above this upper band would be needed to ease bearish pressure and signal that a more durable bottom may be forming. If you enjoy my work, feel free to send a YouTube super thanks or buy me a coffee to help keep the channel going. Thanks for being here and I'll see you in the next one.